5 things that you should avoid when you're in a falling market. So, what are those things? What do you have to do? How does it work? I'm going to tell you it all. My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach. And I'm on that quest to change the middle class of India and transform their financial life in such a way that they are able to have the potential to follow their passion. They have the focus to follow their passion. They are not distracted by money because they're creating enough passive income. And most importantly, they're able to live with inner peace and joy. And that, my friends, happens by winning the game of money. That happens when you upgrade your financial IQ, and that most importantly happens when you are committed to achieve financial freedom in your life. Because it cannot happen without a commitment, and it is my commitment to make sure you get all the support that you need to walk and achieve that destination. 5 things that you should avoid when you're in a falling market. So, what are those things? What do you have to do? How does it work? I'm going to tell you it all. Okay, because we are in a falling market, and this is a time to make sure that you are able to make wise financial decisions. If not benefit, at least not lose money in this time. And this is the time to really make a lot of money. So, what is it? I'll give you a lot of understanding, psychological. And not just psychological, but actually execution based. What are the things that you can do out of it? So let's get started. Here is the first one. The first one is panic selling. You know, when I was reading technical analysis, it's a very big fat book. Showed it to you guys a few times. And the book the chapter was called turnarounds. Turnaround means either the top or the bottoms. And it said that whenever the market is about to turn around, the volatility is going to be highest. Which means what? If the markets are going down, the maximum panic is when what? People who have bought, the value of that is less, right? So maximum panic is mostly when there is maximum volatility. And why is there maximum volatility? Because most people are afraid. So what is happening at the bottoms of the market, wherever they are, is that people who do not have the will or vision to hold on to their investments because they see a massive notional loss and they don't want to see any further notional losses, or people who have been leveraging their investments and they don't have any more margin money, at this point they're selling like fanatically. This creates a very quick, deep fall in the market. Like within the day, market is going 5% up and down, something like that. Just as an example. Once that happens, what really happens in the background is that people who are opportunistic and people who prepared for such times are the people who are actually buying it. So people who waited, people who created the right financial mindset and skills, the right skills that they use at this time, with obviously the financial cash flow they created. If you use all of them together at this given point, this is when you're going to get the highest ever return on your investment. It still might not be that you bought the lowest price, but you'll be very much at the bottoms. So panic sellers are the ones who really make us wealthy, because they are the ones who would sell at the maximum loss possible, and we will be buying from the maximum gain possible. So we need to be on the other end of the spectrum, right? So panic selling is a tool for us. It's not something that we have to fall to the prey of. We have to benefit from the people who are doing panic selling. And that pretty much has been evident in the financial markets in the last few months. So now let's talk about the second one. And that is a very common one. People talk of bottom fishing. Where is the bottom? I'm going to buy from the bottom. And mostly for people, the bottoms are, where? On psychological levels. Like aajkal people are talking 14,500 is the bottom, or 15,000 is the bottom. So when everyone is saying 15 is the bottom, the market rebounded from 15 to 100. So it will not touch that psychological level. Or if it goes to that psychological level, it might go even further. people, without doing any analysis, without knowing either technical analysis, which is all about knowing the right price to buy at, they mostly use psychological levels and they try to bottom fish. They try to bottom fish using either psychological levels, that's one way, or the second method that they use is that itna percent gir gaya hai, 30% gir gaya bahut hai, ye bottom hoga. So either or, this is what I've generally seen. People use either of these and then make financial decisions. It's a market 18,000 pe tha, 16 pe aa gaya, let's buy. Or 30% gir gaya, let's buy. So those are almost not the right ways of doing it. Today I will be telling you better ways to know how to value the market. And even then you will not be able to fish the bottoms. You know, I can say this with pride that we have bought the bottom 5% of the market in the last few falls in the last 7-8 years. But it's not that we were not prepared for the next fall and had another level in mind. And it's also not that we did not invest before that level. We had certain levels before it too. The ideology should be to invest your money on every single major level. And you don't know which level is going to be the bottom. That is what the financial mindset and the systems have to be about. That you are financially prepared and you're mentally prepared to invest into every bottom. Now you would come to realize why are we so aggressive to invest into debt, because this is one instrument which really helps you in a time like this. You can almost invest in 3 or 4 major levels if you are appropriately investing into debt, even if you don't have your own fresh cash flows to invest in, right? Are you all able to relate to what I'm saying? Are you able to experientially understand now why debt is being preferred so much? Why was debt being preferred so much in the last year? And how debt now can play a very big instrumental role in now buying the bottoms or the dips. Even if you might not have fresh cash flow, even if you're not able to sell other assets and buy this, now you can easily use your debt to convert your portfolio into more aggressive equity-based portfolio. Yes? So how will debt help? So debt can be, debt that we have bought in the past can be sold, and now equity can be bought. So not only did you save yourself from the fall in the financial markets, and you almost saved yourself from 15 to 20% fall in the indexes or 30 to 50% fall in the stocks, but not just saving yourself from it, you also made money in the debt. So you're coming out in positive. And then now you're moving your money into equity using tactical asset allocation. And doing that not only creates a balanced portfolio, it also helps you to move your money from asset to asset at the right time. Yes. So the third one is again to do with the mind, and that is all emotional buying. So mostly people, even big investors I've seen, people who have a lot of money, they go for emotions that, I want to invest with this company because it has fallen so much. So ये एक emotion है उनका, there is no analysis here. They talk of that I want to invest only this amount of money, not any analysis. Not, let's say if someone invested 10 lakh rupees on level 1, they again should be investing 10 lakhs in level 2, right? But their emotion, they're a bit unsure. So they'll invest 5 lakhs and they will miss out on the opportunity of correct averaging. So whenever you use your emotion could be happy and overexcited, you will end up investing more than what you should. Or fearful is when you will end up not investing, or you'll end up investing less than what you should. So investing is a very mathematical way of doing things. The more emotion you do, and this is a very funny saying, that the surest way to not make money in the financial market is using your emotions. Because your emotions are always up and down. Either you're positive or negative. You need to be somewhere in the middle, neutral. And when you're in neutrality is when you're actually using analysis and data. That helps you to bring yourself to being neutral. Positive, no. Negative, no. Should not be positive because you don't know the future. You should not be negative because, again, you don't know the future. What you do know is stats, facts, numbers, and past trends. If you use that in a certain analysis, you are neutral. And then you're making financial decisions based on that. And using a good financial model, you can really make a lot of money. And that is what we're trying to do on the back end for you. So that we tell you how much you should invest where. So that you don't have to apply your thought process, because with your thoughts, your emotions can also come into play. The only thing left there is now what? Just do it. Do it by experience. This is why the course is a year old, because a year long. Why? Because you want to experience different cycles. So you experientially say that, okay, good that I did not use my emotion, good I did this. And this is the result I'm getting. Okay. So with that, let's move to the fourth one. And this is, I don't know, is this ironical? But whenever major crashes come, we have people who are doing SIPs of even 1 crore rupees, 1 crore SIP. And those people who have 10, 15, 25 lakh rupees SIP, many of them at this point somehow have stopped. I don't know why. Is it cosmic? I don't know. Is it coincidence? I don't know. And the people who have been committed are still doing their SIPs. Is it a matter of big amount, small amount? That could be a factor. Is it that they have other priorities or some other reason is there? I don't know. Are they afraid? Maybe, I don't know. But stopping your SIPs at a time like this is crazy. This is the time to go aggressive. This is the time to show if you're an aggressive investor or not. This is the time to really rebalance your asset allocations. So stopping an SIP right now is probably the worst thing you can do to your portfolio. Again, like the story of commitment I told you today, SIP is a lifelong commitment. Like, do you know the first debit that happens in my business account every month is my SIP amount, and I don't touch it. It doesn't even go through my account. It goes through my wife's account. So I don't even get to see that money. That money debits from my account, goes to my wife's, gets invested. So this is the kind of discipline that we have created in our financial life, because no matter what is happening, my investments should never stop. Once you're in that system, automatically that financial discipline will build. Either you are so strong-willed you're able to do it, or you create a system where your willingness or your will is not even required. It just happens by itself through automation. This is what financial systems is all about. So we need to find our own ways to do it. But make sure that you do this with absolute discipline. This is the time to increase SIPs, to add money into lump sum, not stop SIPs for sure. So is it better to buy more during such time? Absolutely. So there have been many levels that the team has been discussing with everyone. We've been sharing certain indexes to invest in, certain price levels to go into. So if you speak to Samya, she'll be able to guide you how you can go about actually investing in what as per the current scenario. Then comes the fifth one, and that is loss aversion. It could be, and how do we do loss aversion? By averaging. So one thought process is loss aversion, and the worst one of that is averting the notional loss. Why notional? Because you haven't sold it yet. So it's not a booked loss. What you bought at 100 is now at 70. It's a 30% notional loss. So there are two ways of overcoming it. Most people do by buying more. And if something that they've bought at 100 is now at 70, kind of already shows that they did not really do a very good analysis at it, because they bought something which was more prone to fall. And you will get to know that when you compare the fall of the market versus what you bought. So if what you have bought has fallen less than the market, then obviously what you have bought is of greater superior quality, which is why it has more buyers, which is why the price is at a higher level. At the same time, if what you bought has fallen more than the market, clearly shows that you did not give valuations much consideration. And now this is a big lesson to learn, because value investing is the only surest way. And today I'll also give you another example of certain momentum funds which are getting battered right now. because value investing is the surest way of making money in the long term, though. And this is also a topic we've covered in the past classes. So what most people do is they try to overcome the loss by investing more. So here multiple mistakes are done. One, you overinvest into a particular financial instrument or an asset class because you're trying to average. So your asset allocations could go off way, or a particular product gets too much allocation, which means your dependence on the performance of that particular product is extremely high. Or your allocation into one certain sector or one certain company becomes too much. Again, these are all big mistakes to be done. That's something most people don't see. The other is, if this particular instrument or whatever you're investing in, you're investing more money into it and it has fallen too much, it still is likely to fall even further because maybe it still hasn't reached its true valuation and no one knows where it's going to bottom out from. Again, it creates that scenario where you're likely going to see even more financial distress. And this later will bring us to point number one, which is panic selling. Now that you made so much loss, either you sell it or you have to sit for a longer period of time for it to break even. Forget profits, break even. At this time, do you know how people are thinking? I don't want profits because they've seen so much loss. They've seen so much internal conflict in their head. Now they just want to get out of it. And they just hit break even and they exit. Now maybe the stock delivers fantastic returns. So these are, psychologies of investing, and one needs to really play on this. If you play by these 5 rules of the game of the fall of the financial markets and use exactly opposite of it, you for sure are going to make money.